Good day, students. I will be doing this question 2, and it's a very important question to take into account. And it says the following pre-adjustment trial balance was applicable at year end 31st of March 2016. So now we are given all this information in the pre-adjustment trial balance, and we are given the assets, property, vehicle and office equipment with their accumulated depreciation. And very importantly to take into account is the fact that we have prepaid advertising expense at the beginning of the year, and this was prepaid from last year, and it's 1,500, meaning now we have to make a reversal in the current year. And when we make a reversal, we have to record the prepaid expense on the credit side, because a reversal is to record an account in the opposite side, of which in this case our prepaid advertising was recorded on the debit side. So when we do a reversal, we record it on the credit side, because the reversal of debit is the credit side. And we have stationery on hand, and the stationery on hand was 700 beginning of the year, and we have to make a reversal for the stationery on hand, where we transfer the stationery into an expense account or stationery expense account. And when we do that, we will be crediting, because the reversal of debit is credit. Then after, we have accrued salaries and wages that were also accrued beginning of the year, and that was a liability obviously by end of last year and current year, which will be reversed on the debit side. Then after, we also have rent that was received in advance beginning of the year. Then this will have to be reversed, and when we reverse this, we have to debit income received in advance or rent received in advance. Then after, we have accrued interest expense also, which was 21,600 accrued. Then we have to make a reversal of this, and when we reverse the credit entry or liability, we have to reverse it by debiting that accrued expense. Then after, we are given normal entries, our incomes, they go throughout, and from here we have other incomes that are recorded on the other side of this trial balance. Then after, we go to the last one there, it is interest expense. That is the last expense to take into account. Then now we have additional information that has to be taken into account. Then from additional information, we'll have to go straight to the requirements, and I always prefer to start with the requirements before I do the adjustments. So now we are required to prepare all the general journal entries and the additional information, as well as reversal entries. So now we have to do everything, including the reversal entries. Then after, we are also required to prepare the following ledger accounts, which is telephone, salaries and wages, stationery expense, and advertising expense. Then after, we are required to consider all the relevant information and to prepare the statement of comprehensive income. Then after, we are further required to prepare other financial statements, which is the statement of changes in equity. Then after, we are required to consider all the relevant information to prepare the statement of financial position at the end of the current year. So now this is what we are required, and I always prefer to start with the financial statements whenever I do the requirements. So now, meaning I will start by doing all the adjustments, including the reversal. Then after, this will be number 2 or follow-up. Then from here, I will do the statement of changes in equity. Then after, I will immediately do the statement of financial position. So now this will be number 3, this will be number 4, in terms of how I will structure it. So now, I have to first do a rough draft of all the financial statements based on the information that is given, because I know that income statement is required, equity statement is required, and the balance sheet statement is also required. So now let me draw a rough draft of all these 3 statements. The first one is the statement of the statement of comprehensive income, which is normally known income statement. So now starting with that statement, we draw it and we say statement of comprehensive income. And the statement of comprehensive income is for the year ended because it shows the performance of the business for the year. For the year ended 31st of March in the year 2016. So now this is the year in which we do this comprehensive income. We start with our revenue, and our revenue is made of service income. Then from service income, we'll first have to check if is there any other income that we have to take into account. There we do have our service income at the bottom, and our service income is given to be 1,352,000 rands. And there's also rent received, which is another income, 112,000 rands. So now I have to record this amount, and our service income is 1,352,000 rands. Then after we have rent income, and our rent income appeared to be 112,000 rands. So now I just record all the amounts that to be recorded in the income statement as they are given in the trial balance before adjustments are taken into account. Then after I say less expenses, and under expenses I just record all the expenses as they appear in my trial balance. The first expense is bank charges. The first expense, bank charges of 20,000 rands. Then I record my bank charges of 20,000 rands. Bank charges of 20,000 rands. Then I open brackets 20,000 rands because there might be an adjustment for bank charges. So now I just take that which is before the adjustments were taken into account. The next expense as it appears in our trial balance, the next expense appears in our trial balance is advertising expense. There we do have advertising of 33,500 rands. Then we record advertising as 33,500 rands. Advertising 33,500. And the next expense is telephone expense for 9,300. The next expense is telephone for 9,300. Telephone 9,300 rands. And the next expense is water and electricity 21,215. Water plus electricity 21,215 rands. Then after we have our stationery expense. This is stationery expense. Take note of that. It is 14,000 rands. So we record our stationery expense as 14,000 rands. Stationery is 14,000 rands. Just recording all the amounts that you see in the trial balance that are to be recorded in the income statement. Then after we have salaries and wages for 127,000 rands. Salaries and wages for 127,000 rands. Salaries plus wages. Salaries plus wages. 427,000 rands is the amount. And the next expense is credit loss, and our credit loss is 1,200 rands. Credit loss 1,200 rands. Then we record the credit loss, and our credit loss is given to be 1,200 rands. The last expense that we have, it is the interest expense of finance cost for 39,200. But there is another expense that we must make provision for, which is normally called depreciation. Although it's not here, but there might be a need for depreciation. So now let us make provision for depreciation. Then after we record our finance cost, which is interest expense. And our interest expense is given to be 39,600. 39,600. We open brackets 39,600 rands. So now that will be our total expenses, and the net of this will give us profit for the year. This will be our profit for the year. Then we do the next statement, which is the statement of changes in equity. Statement of changes in equity for the year, and for the year end 31st of March 2016. And this statement starts with the opening balance, and the opening balance is size an amount of the capital, or you can just say capital. Then after we record profit for the year. Profit for the year comes from the income statement, and our capital or opening balance definitely must be recorded already in the trial balance. And in the trial balance we do have the amount of capital, and the amount of capital that appears in our trial balance is an amount of 1,505,220. So now that is the 1,505,220, and we record that amount as our opening balance, 1,505,220 rands. Then that will be profit, 1,505,220 rands. Then our profit for the year, we don't know how much it is yet. Then if there are drawings, we have to record our drawings, and our drawings are given already in the trial balance, and the amount of drawings there, it is 14,500, and we open brackets, we record 14,500 rands as the amount of drawings. Then after, if there is capital contribution during the year, that will be recorded too. So now we have capital contribution during the year. Then after, we'll get to the closing balance of the statement. Closing balance, and closing balance will be here, and it will be transferred to the statement of financial position. Now the last statement, which is the statement of financial position. Statement of financial position as at 31st of March in the year 2016. It starts with assets. Then after assets we have non-current assets, and under non-current assets we have property, plant and equipment. And under property, plant and equipment we record the property of 1,600,000 rands. Let me show you that. We do have an item of property, and that item of property is 1,600,000 rands. We record that. Then after, we also add vehicles of 70,000 rands and office equipment of 50,000 rands. So now it's all these three amounts. So now we add 70,000 for vehicles because this is an asset, and we add office equipment because this is also an asset of 50,000 rands. Then now later on we'll have to record the total accumulated depreciation, which is 7,000 and 9,000, after we have added the depreciation for the current year. But these two will have to be added, which is 9,000. Then we have to add depreciation of the current year, and we subtract all of them in that property, plant and equipment line item. Then after, we go to current assets, and under our current assets we have inventory, and under our current asset we have inventory. Then after, we have trade plus other receivables, trade plus other receivables. And the trade and other receivables, we do have an amount. When it comes to this, we can record, will record in fact the amount of the stationery that is left at the end of the year. So now we can ignore that so far. Then we have to record the amount of trade and other receivables. There is our trade and other receivables, 708,500 rands. 708,500. Then after we go straight to the bank account, and our bank account is an amount of 557,330. 557,330, that will be our bank. 557,330. Then we go to equity and liability. Equity plus liability. And under equity and liability, we start with the equity. And equity is the one that will be from the statement of change in equity. Then from equity, we record our liabilities. And since we know that our liabilities are divided into two, there is a non-current portion. And under non-current portion, we record long-term loan. We record long-term loan. And our long-term loan is given, I think in the trial balance, we do have a long-term loan. Our long-term loan is an amount of 120,000 rands. So that is our long-term loan. Long-term loan is 120,000 rands. Let us write that. Then after we go to our current liabilities. Current liabilities, we have trade plus other receivables. Trade plus other receivables. Trade plus other receivables. And under trade and other receivables, we have an amount of trade and other receivables that is given to us. And here is the trade and other receivables. Trade and other receivables, 700, sorry, trade and other payables, trade and other payables, 126,540. Trade and other payables, 126,540 is not the receivables. Trade and other payables, because we are dealing with the liability. And it was 127,540 rands. Let me confirm that. 126,540, 126,540, not 127. So that is 126,540 rands. Then now we have completed all the statements that were required for this, the major statements that were required for this exercise. So now from here, I will just do the adjustments, and after I'm done with the adjustments, then I will immediately now record each adjustment where it's supposed to be recorded. So now we have to start first doing the reversal entries and reversing all the accruals that were there at the beginning of the year. So now that's what I will first be doing. Let me just delete everything so that we are very clear of what is happening and where we are going. So now we first start with the reversal, where we reverse our prepaid expense, reverse our stationery, reverse our accrued expense, reverse our rent received in advance. Then after we do the reversal of the accrued interest expense of 21,600, and reverse that rent, reverse that accrued. So now these are the reversals that I will be doing, and immediately for every reversal I will record it in the statement it is supposed to be recorded. So now with that, let me start with the first reversal, and the first reversal is the prepaid advertising, which is number 1. So now I go to my reversal, then I write here on top reversals. Then our reversal first is the reversal of the prepaid advertising. We know that advertising prepaid by the end of last year was an asset, and it was recorded on the debit side of the trial balance. So now because of that, we have to make a reversal, and when we make a reversal now, this has to be recorded on the credit side. That means we are reversing the asset because prepaid expense is an asset. However, now the minute it is no longer prepaid, we have to cancel the asset, and to cancel the asset, we have to credit the asset. That is why now we'll have to debit our advertising expense. We debit our advertising expense, advertising by 1,500 rands. Then after we credit our prepaid advertising. we credit our prepaid advertising. Prepaid advertising by an amount of 1,500. So now we have to record this on the income statement because advertising is an expense. This is an expense and it has to be recorded in the income statement. However, we don't record this anyway because the minute we credit our prepaid advertising, this prepaid advertising is cancelling the prepaid advertising, which is a credit here, which is a debit here, because here is debited. So now the minute we credit prepaid advertising, immediately we are cancelling the prepaid advertising that was recorded on the debit side. So now when you make a reversal, we cancel the reversal when we do the general entry. So now that is why we only have to record the amount of 1,500 in our statement of comprehensive income as increasing our advertising expense. So now under advertising, we say plus 1,500 rands. Then we go to the second reversal, and the second reversal was is supposed to be the reversal of the stationery on hand, and the stationery on hand is 700 rands. So now we have recorded and we have done this entry in terms of reversal. Then now we go to the stationery on hand. Remember, this stationery was an asset by the end of last year, and now it has to be transferred from an asset account into an expense account. So now if this is an asset and it's on the debit side, when we reverse, we have to credit 700. That means we have to credit our stationery on hand and we debit stationery expense because we are transferring the stationery from an asset account into an expense account. So now let us do that journal entry or reversal entry once again. So now when we do that, we debit our stationery expense, debit our stationery expense. This is stationery expense by an amount of 700 and we credit stationery on hand. We credit stationery on hand. And our stationery on hand is 700 rands. So now once again, we don't record the credit side anyway. Why that is the case is because when we credit stationery on hand, we are cancelling the stationery on hand that was on the debit side by the beginning of the year. This is the debit entry. So the minute we record 700 on the credit side, which is the one that is recorded in this journal entry, we have cancelled the stationery on hand immediately. So now that means we only record the debit side of this entry, which is the stationery expense, where our stationery expense will have to be increased by an amount of 700 rands. So now we go to the statement of comprehensive income, and we know that stationery is an expense and expenses increase on the debit side. Then this will be plus 700 rands under our stationery expense. Then we go to the next adjustment once again. The next adjustment or the next reversal entry is the reversal entry of the accrued salaries and wages. Accrued salaries and wages was an amount of 3,300 rands. Remember, accrued expense is a liability. So now for us to cancel a liability, it has to be recorded on the credit side. Therefore now on the debit side, that means the accrued expense reversal, we have to debit it and credit salaries and wages because the reversal of credit is debit in simple terms. So now we have to debit our accrued expense and we credit salaries and wages. We debit our accrued expense because we are cancelling the liability. Accrued expense, which is the salaries and wages. Then after we credit our salaries and wages. Salaries plus wages. And that is an amount of 3,300 rands. 3,300 300 rands. So now it means in this case, once again, we don't record this anywhere. Why that is the case is because the debit side of the accrued expense, where the accrued expense is debited, it is cancelling the entry which is on the credit side of the total balance. That means the minute we record 3.3 on the debit side, we have cancelled this entry and the balance after that will be 0. So now that is why we don't record the debit entry in this case. So now we have to record only the salaries and wages by 3,300, where our salaries and wages will have to be reduced by 3,300 rand under the statement of comprehensive income. So now we go to our salaries and wages. We say less 3,300, which is the reversal entry, less 3,300 rands, less 3,300 rands. Then after we go to the next entry, and the next entry is the rent received in advance 1st of April. And remember, income received in advance is a liability. That is why the rent received in advance is recorded on the credit side, because last year it was a liability. We received this rent before time. So now meaning when we do a reversal, we have to record this on the debit side. Remember, reversal, you record the entry on the other side or on the opposite side. I've been highlighting that since the beginning of this question paper. So now again, we'll have to record the rent received in advance on the debit side because it was on the credit side, and the reversal of the credit is debit. So now that means we debit our rent received in advance and we credit our rent income. So we debit our rent received in advance, debit our rent received in advance, rent received in advance, and our rent received in advance is an amount of 10,000 rands, and we credit rent income. We credit rent income by 10,000 rands. So now once again, I think now you're supposed to know which entry will not be recorded. The entry on the debit side is the rent received in advance, meaning now it's debited. The minute we debit, it means we are cancelling the credit side because it was a liability on the credit side. The minute we record 10,000 on the debit side, is 10,000 less 10,000, we get 0 in terms of the rent received in advance after the reversal has been taken into account. That means again, the debit side will not be recorded, but we only record the rent income of 10,000 under the income statement, and that will be plus because incomes increase on the credit side. Then we have to say plus 10,000 rands under our rent income under incomes. Then after we go to the next reversal, if there is still another reversal to take into account. Now another reversal is the reversal of the accrued interest expense. Reversal of the accrued interest expense. All the accruals, guys, and income received in advance or prepaid expense or accrued expense, they must be reversed when you do your financial statements. So now here again, our expense in terms of interest which was accrued was a liability last year, and we make a reversal, we'll record it on the debit side. That means we have to record 21,600 on the debit side, meaning now we are cancelling the liability and it doesn't become a liability anymore. Then now it means we have to debit our accrued interest. We have to debit our accrued interest. Accrued interest by 21,600 rands, and we credit interest expense. We credit interest expense by 21,600 rands. Once again, we don't record this entry. The reason why we don't record this entry, it is because of the fact that the debit of this accrued expense is cancelling the accrued expense that was recorded on the credit side. So now that means immediately when we debit accrued expense, this account will become 0 balance. Therefore now we only record the amount of the interest expense of 21,600 on the credit side. That means our expenses are decreasing by 21,600 because expenses decrease on the credit side. Then that will be less 21,600 rands that will be recorded under the interest expense. Then after we go and we record any other reversal, there is no other reversal. All the reversals have been taken into account. So now if we have accounted for all the reversals, that means we have to record now all the adjustments that we have in the adjusting entries. So now let us go straight to our adjusting entries or our general entries. So now our general entries, they start with number 1. And number 1 of our general entries tells us that an amount of 1,500, an amount of 1.5 for telephone for March 2016 is still to be paid. And this entry was not yet accounted for in the above trial balance. So now this still has to be accounted for. And remember, it said still to be. That means not yet paid. In other words, payable. And anything that is payable, it is to be recorded as a liability because it's not yet paid, meaning we are still liable to pay it. So now that is why we have to debit the telephone expense and we credit the accrued telephone expense. So now let us do a general entry for that and we record it in our financial statements immediately after recording it. So now we start with general entry number 1. And general entry number 1 is the debit of the telephone expense for 1,500 and we credit accrued telephone. Credit accrued telephone expense for 1,500. So now in this case, remember, this is an accrued expense by the end of the current year. And an accrued expense by the end of the current year is a liability. So now it must be recorded as a liability also under trade and other payables in the statement of financial position. So now here is our expense, telephone expense on the debit side. And our expenses, we know that they increased on the debit side. And we go straight to our expenses under telephone and we increase our telephone by an amount of 1,500 rands. Our telephone we say plus 1,500 rands. Then after we go to our trade and other payables in the statement of financial position, we add the 1,500 because it was not yet paid by the end of the current year. Then now we go to the next entry and the next entry is entry number 2. And entry number 2 says that a salary of 300 per month is still payable. That means not yet paid again for the month of March in the year 2016. That is still another accrued expense that we have to account for. So now we have to debit our salaries and wages and we credit our accrued salaries. Then that is number 2. We debit our salaries plus wages. Salaries plus wages. And that salaries and wages, I think is an amount of 300 rands. Yeah, an amount of 300 rands only. It was not yet paid by the end of the month. Then we credit our accrued salaries and wages. Accrued expense or accrued salaries and wages. And that will be 300 rands. Meaning now we have to increase our salaries and wages by 300 and increase our trade and other payables by 300 rands. Then now we increase our salaries and wages by an amount of 300 rands. There is our 300 rands. Then under trade and other payables in the statement of financial position, we have to record 300 because this salary was not yet paid, still payable. Therefore now it is under payables, trade and other payables. Then we go to the next general entry. And the next general entry is general entry number 3. And general entry number 3 says that a portion of the building was rented out to a tenant from the 1st of March 2014 for 10,000 rands per month. So now that is 10,000 rands per month, meaning rent per month is 10,000 rands. So now we have to provide for the outstanding rent. That is the purpose, to check if is there any rent that is outstanding. And this is very important because there was a rent that was received from last year. We need not to be ignorant of that rent. We need to take that rent into account. There was a rent received in the current year, 112,000 rands. And there was a rent that was received last year for the current year, 10,000 rands. So now it means if we received 10,000 of rent from last year, it means in the current year, we're supposed to receive only 110,000 rands because 10,000 of rent was received last year for the current year. So now it means if we receive any amount above 110,000 rands, that will be another rent received in advance. So now we say, okay, we have a rent, and the rent is 10,000 rands. Then if we say times that by 12, it will give us rent for the year, and rent for the year will be 120,000 rands. It means in the current year, if we had received the full amount, in fact, in a full year, we must receive 120,000 rands for the year. However, there was 10,000 that was received last year. 10,000. Therefore, now it means we're supposed to receive only 110,000 for the current year. Why am I saying that? Because in my trial balance, there is rent received in advance on the 1st of April, meaning this rent was received last year for the current year. So which is 10,000 rands, meaning we must not receive another 10,000 for the current year, but it was received last year. So now it means we're supposed to receive 110,000 rands. But how much of rent did we receive? We have already received the rent. Here's rent received, 112,000 rands. So now we received 112,000 rands instead of 110,000 rands of rent for the current year. So now it means if we say 112,000 rands less 110,000 rands, that will give us the amount of rent that is to be recorded as income received in advance. Because instead of us receiving 110,000 rands in the current year, we received 112,000 rands, which is that 112,000 rands, this one. So now that means we received again 2,000 more than what we're supposed to receive in the current year. So now that is the rent that we are to record here, which is rent received in advance of 2,000 rands. Very important entry to take into account. So now we debit our rent income. We debit our rent income. Remember, income received in advance is a liability by the end of the current year. So now in this case, we have rent received in advance, which is a liability. Therefore, now we must increase our liabilities. Rent received in advance. Rent received in advance. And the rent received in advance is 2,000 rands, which is a liability. 2,000 rands. So now we have to debit our rent expense, rent income, or reduce our rent income by 2,000 rands because incomes decrease on the credit side. Then after, we have to increase our liabilities by 2,000 rands under trade and other payables. So now let us do that as it is supposed to be. Then we say less 2,000 rands. And if we do that, this should give us 120,000 rands because that is the rent which is for the year. Then after, we go to the other side where we record income received in advance. And we know that income received in advance is a liability. So now that will be increasing our liabilities. And this is the income that was received in advance, which is this rent of 2,000 rands was received in advance, which is a liability. The tenant paid us before time. Then we go to journal entry number 4. And journal entry number 4 says that we have to take into account the following entries. Journal entry number 4 says that on checking accounts receivables, it was found that a debt of 1,200 must be written off as irrecoverable. So now here we have another bad debt or credit loss, and we know that credit loss is an expense, and expenses increase on the debit side, meaning we debit our credit loss or bad debt and we credit our debtors, and that will be an amount of 1,200. So now our credit loss will increase by 1.2 and our debtors will increase by 1.2 at the same time. So now we record under our debtors 1.2 because our debtors, they decrease by 1,200 rands, which is a bad debt. And at the same time, our expenses, they increase by the amount of the bad debt, where we say plus 1,200 rands. So now that is another bad debt above the 1.2 that was already in the trial balance. Then we have recorded that in the financial statements as it's supposed to be. Then now we immediately go to the next general entry or additional information. And under our additional information, which is number 5, it tells us that it was decided to increase the allowance for credit loss to 2.5% of the account receivables. That means we have to record our outstanding credit losses, and in the trial balance we had an amount of our outstanding credit loss. I will show you that now. So now we know that it must be out of the outstanding debtors, 2.5%, and we know that 1,200 is a bad debt, and this bad debt is not yet removed in our debtors. So now we need to go to our debtors in the trial balance, and when we find our debtors in the trial balance, we subtract the 1.2. Here is our trade receivables, 708,500, meaning when you calculate our allowance, now we have to say allowance is equal to our debtors 708,500 less 1,200. 1,200 is the bad debt for the end of the current year. Then now we have to subtract the two. We check how much is our outstanding debtors. So now that will be 708,500 minus 1,200, and that gives us 707,300 rands. And we multiply this by 2.5%. And we multiply that by 2.5 divided by 100. And this will give us 17,683. 17,683. So now this is the amount of the allowance for credit loss. However, we already have our allowance for credit loss that is recorded in the trial balance already. Now our allowance for credit loss, we can see there in the trial balance that it is an allowance for credit loss of 1,685. So now that is the amount that we have as our allowance for credit loss. So now it has increased from 1,685 up to 17,000. Let me check that. Up to 17,683. 17,683. So now that means our allowance went up from 1,683 to 17,683. 1,685 up to 17,683. So now it means our allowance went up by the difference. We have to say minus 1,685. The difference is the one that will be recorded under our income statement. Then we say minus 1,685, and the difference will be 15,998. Round off to nearest rands. So now this will be recorded in the income statement. This will be recorded in the income statement, and the total amount that we calculated as the new allowance will be recorded in the statement of financial position, which is the balance sheet. That is the amount of the balance sheet, the total amount. However, in the income statement, we only record this entry of the allowance for credit losses. So now let us go and we do that allowance for credit losses. So now the journal entry, it is journal entry number 5, where we debit our bad debts, then after we credit allowance for credit loss. Allowance for credit loss. Our bad debt, remember this contra entry can also be debtors because it is reducing our debtors. Sorry, not debtors, because debtors they don't decrease on the debit side. So now that will be our bad debt, which is 15,910.98, 15,910.98. So now if this is 15,998, it will be recorded under expenses. Then we record this under income statement because it is an expense and it will increase our bad debts. So we record that under our credit losses. It will be plus 15,910.98. Then we close this there. Then after we have to take into account the total of the allowance that we have calculated, and we record that in the under trade and other payables. We say less, and the amount that we calculated is 17,683. This is the amount that we record in the balance sheet in total. Remember, if you want, you can say 15,000, or you can say in the balance sheet under debtors, you can say 1,685 plus 15,998. Obviously, this will give you the same 17,683. So now either way you do it, it does not matter. 17,683. This is the amount that will go to the statement of financial position in the balance sheet under debtors, where our debtors will be reduced by the total of the provision of our bad debts, 17,683. 17,683. So now that will be 17,683 rand that we are recording under our trade and other receivables. Then we go to the second adjustment, and the second adjustment is adjustment number 7 and adjustment number 6. Adjustment number 6 says that the mortgage loan the mortgage loan started on the 1st of April in the year 2010, and it is expected that 45% of the loan will be repaid on the 30th of April 2016. And since interest at 18% is payable per annum, provide for the interest payable. So now they are telling us in the first part that it is expected that 45% of the loan will be payable by 3rd of April, meaning 45% of the loan is a current liability. Why am I saying that? Because we are doing the books for the year that ends 31st of March 2016. That is where we are, 31st of March 2016. That is the books that we are dealing with. So now, meaning if the next payment will be on the 30th of April 2016, that means just 1 month after I will make the payment, meaning 45% of the loan will be a current liability. So now we know that our loan is 120,000 rands. Here is our long-term loan. Here is our loan. That means 25% or 45% of that will be a non-current, and 55% of that will be a current. So now we say 55% is non-current and 45 is current. 120,000 rands times by 55%, then that will give us 66,000 rands, which is a non-current liability. Then after we say 120,000 rands times by 45%, that will be a current portion of the loan. That will be portion of the loan. portion of long-term loan, and portion of long-term loan is 54,000 rands. That 54,000 rands is 120,000 times by 45%. 120,000 times by 45%. Times by 45%. After this has been multiplied by 45%, it will give us the current portion. Then now we go to the interest portion of this journal entry, where they are telling us that the interest is 18%. We are told that the interest is 18% and is payable per annum. We must provide for the outstanding interest. So now that we know that our loan is 120,000 rands, so meaning interest will be 18% of the loan. 120,000 rands times by 18%. And if we say this time by 18%, it will give us the amount that will be the interest on a loan for the full year. 120,000 rands, multiply this by 18%, it will give us 21,600 rands. 21,600 rands, that will be the amount of the interest. So now we first have to check if did we overpay the interest or underpay the interest. Let us check based on our interest that we have. We have interest expense that was paid 39,600. This is what was paid already. This is interest expense which is paid already in the current year during the year. However, last year there was interest expense that was accrued. And the interest expense that was accrued, it was an amount of 21,600 rands. Here we had accrued interest expense of 21,600, meaning the full interest last year was not paid. And it means in the current year, in order for us not to owe anything, we're supposed to pay 21,600 of last year plus 21,600 of the current year. That's what we're supposed to do in order for us not to owe any interest, because we still owe 21 of last year and 21 of the current year. Meaning the total interest that we're supposed to pay in the current year so that we don't owe any interest on this loan is 43,200. This is what we're supposed to pay in the current year, where we pay for the previous year and we pay for the current year. However, how much did we pay? We only paid 39,600. This is what we have paid. So now if we pay 39,600, it means we still owe them the difference of 3,600 rands, and this amount is accrued interest expense. This is accrued. So now don't forget the fact that last year we still had another accrual, which was accrued interest. So now we have to take that into consideration. That is why now when we do the journal entry, we debit our, which is journal entry number 6, we debit our interest expense. We debit our interest expense for 3,600 and we credit accrued interest. Accrued interest for 3,600. So now interest expense will be debited by 3.6. Interest expense will be debited by 3,600, which means it is a plus 3,600 in other words. Then after there is accrued expense, and accrued expense is a liability. And that liability which is accrued will be added here plus 3,600 plus 3,600. Then after we go straight to the last adjustment, or the one before the last adjustment. That adjustment is adjustment number 7. We still have 2 left. Adjustment number 7 say that vehicles must be depreciated at 10% per annum on the diminishing balance method. And let us first do the vehicles first. Vehicles are depreciated at 10% on the diminishing balance method. So now if vehicles are depreciated on the diminishing balance method, we need to say cost less accumulated depreciation. So now we are doing depreciation, and that depreciation is for vehicles. Depreciation is for vehicles, and it says cost less accumulated depreciation. Cost price of the vehicles is 70,000 rands. There is 70,000 rands. 70,000 rands is for vehicles or vehicle. Accumulated depreciation is 7,000 rands. There we do have 7,000 rands of the accumulated depreciation for vehicle. Therefore now we'll have to say subtract the two, and we get how much is the depreciable amount. 70,000 rands less 7,000 rands, that gives us 63,000 rands. We multiply this by 10%, and this will give us 6,300 of the depreciation for vehicle. Then let us record that in our journal entry. Journal entry is journal entry number 7 that we are busy with, which is number 7. And journal entry number 7, we debit our depreciation and we credit our accumulated depreciation. Depreciation, and we credit our accumulated depreciation, which is for vehicles. Then after, we also have to account for the accumulated depreciation for another asset, and another asset is office equipment. And we know that for vehicles it is 3,600, and we have recorded that. I want to combine these entries. The next adjustment is the calculation of depreciation for office equipment. It says now, while office equipment is depreciated at 20% using straight line method with a scrap value of 5,000. Scrap value of 5,000. Take note of the scrap value. That means now when we calculate our depreciation for our office equipment on a straight line, we need to say cost less scrap value or cost less residual value. Here is our office equipment, and it is 50,000 rands. So now we calculate our depreciation for office equipment, where we say cost less residual value, that is depreciation for office equipment, which is cost price less residual value, and the cost is 50,000 rands, residual value is 5,000 rands, and that gives us 45,000 rands times by 20%. And if we multiply this by 20%, it will give us 9,000 rands. It will give us 9,000 rands. Now, if this gives us 9,000 rands, then it becomes the depreciation for office equipment. So now we go and we record the 9,000 of the depreciation for office equipment. There is 9,000 rands. And we add the 2 times by 10% is 3.6 plus 9,000. That will be 15,300 total depreciation. 15,300 rands of our total depreciation. 15,300 of our total depreciation. So now that will be our total depreciation. Then we record our depreciation in the income statement. Then after, we take into account the total accumulated depreciation in the statement of financial position. 15,300 rands. Then now we have to add the depreciation that we have, because we have the depreciation of total of 15,300 plus 16,000 rands, or in fact plus 7,000 plus 9,000. So now what we are doing now, we are adding all the accumulated depreciation plus the depreciation of the current year. We have 7,000, 9,000 of the accumulated depreciation. We add it to the depreciations of the current year, which is total 15,300. Therefore, now that will give us total accumulated depreciation to be deducted in the balance sheet. So now we have 15,300 plus 7,000 plus 9,000. This will give us a total of the depreciation as 31,300 rands. 31,300 rands. So now that will be deducted in the balance sheet as negative 31,300 less 31,300. This is the total accumulated depreciation for all the two assets. Total accumulated depreciation. So now we go to the adjustment, which is the one before the last. Then after we'll be done with all the adjustments that are necessary for this exercise, or in order to compile the financial statements. Number 8 says the owner took stationery of 750 for his son who is going to university. So now that will be drawings. We all know that we debit our drawings and we credit stationery because the owner took stationery. Then that is number 8. We debit our drawings. We credit our stationery expense. We credit our stationery expense by an amount of 750 by an amount of 750 rands. That means now our drawings will have to be increased by 750 and our stationery decreased by 750. And then we have our drawings plus 750 rands. Then under our stationery in the income statement, we say less our stationery less 750 rands because the owner took the stationery for personal use for the son who is going to university. Then now we go to the last one, which is the stationery number 9, stationery on hand, 4,270. So now we record the stationery on hand at the end of this period. So now we debit our stationery because that is an asset at the end of the year. So now any asset at the end of the year in terms of stationery must be recorded on the debit side. So we debit our stationery on hand, and it's 4,270, 4,270 rands, and we credit our stationery expense. Stationery expense. The debit entry will be recorded in the statement of financial position, and the credit entry will reduce our stationery expense. The debit entry is inventory at the end of the year. That is an asset, 4,270. And we also have to record the credit entry because our stationery expense is decreasing on the credit side. So now that means in the income statement, our stationery expense will have to be decreasing by 4,000 less 4,270. And that was the last entry to record, or last entry to take into account. So now we have recorded all the entries that were necessary. So now we can balance our income statement, and I will calculate all the totals very accurately. So now the first one will be the total of the revenue that we have, which is the total of the two sources of revenue, which is 1,352,000 rands plus 120,000 rands. And that will give us 1,472,000 rands. Then after we calculate our expenses individual, we have bank charges of 20,000 rands. Bank charges, there was no adjustment. Then we have to add our advertising. Our advertising is 33,500 plus 1,500. That gives us 35,000 rands. That is 35,000 rands. Then after we have telephone of 9,300 plus 1,500, which is 10,800 rands. That is 10,800. Then this will be 21,215. There is no change. Then with regard to stationery, we have 14,000 rands plus 700 minus 750 minus 4,270. That will give us 9,680. 9,680. Then after we have our salaries of 127,000 rands minus 3,300 plus 300, that gives us 124,000 rands. Then after we have our credit losses, and our credit loss is 1,200 times 2. That will be equal to plus 15,998. That will be 17,000. Let me confirm that it is 1,200. 1,200 of the credit loss plus 1,200 plus 15,998, 15,998, and this gives us 18,398. Then after we calculate our interest expense, which is 39,600 minus 21,600 plus 3,600, which at the end is 21,600 rands. Then the total will give us profit for the period. Profit for the period. So now we throw the line here and we calculate the total expenses. Total expenses, we have 20,000 rands plus 35,000 rands plus 10,800 plus 21,215 plus 9,680 rands plus 124,000 rands plus 18,398 plus 15,300 plus 21,600. Then this will give us 275,993. It will be 275,993 rand total expenses. Then we have our total expenses. Then we say less our income, which is 1,472,000 rands. That will give us the profit of 1,196,007. So now this will be exactly our profit for the period. Let me just confirm the expenses just to ensure that they are all correct. 20,000 rands plus 35,000 rands plus 10,800 plus 21,215 plus 9,680 plus 124,000 rands plus 18,398 plus 15,300 plus 21,600, 275,993. So now that is 100% correct. Less 1,472,000 rands. So now that is our correct profit. That profit will be transferred to the statement of changes in equity, this profit. We transfer that as it is. It will be 1 million is 1196007. 1196007. Then we record the total of drawings, and our total drawings, it will be 14,500 plus 750. That will be 15,250. Then after we say 1,505,220 plus 1,196,007 minus 15,250, that will give us 2,685,977. Just recalculate 1,505,220 plus 1,196,007 minus 15,250, and that will give us the closing balance of 2,685,997. So that is correct. And we transfer that amount in the statement of financial position under equity as it is, and that will be recorded as the same amount, 2,685,977 rands. So now that will be the amount of the equity, and immediately when that is recorded, we can now record all other assets and liabilities, starting with the property, plant and equipment items. 1,600,000 plus 70,000 rands plus 50,000 rands less 31,300. That will give us 1,688,700 rands. So now we draw a line there. It is 1,688,700. Then we add all the assets. When it comes to bank, there was no difference. There was no entry to record. 55,330 was, or 557,330. 557,330. Then after we have our trade and other receivables, which is 708,500, 708,500 minus bad debt of 1.2 minus the allowance for credit loss that we have calculated, 17,683. Then that will give us 689,617 rands. Then that will be 689,617. That is the amount of trade and other receivables. Then the total of all the current assets, it will be plus 4,270 plus 557,330, and this will give us 1,251,217 rands. Then now we calculate our total assets, which is plus 1,688,700, and our total assets, current and non-current, will give us an amount of 2,939,917 rands. So now that will be our total assets. So now let us check if our equity and liability, they gave us the same amount. We already have our non-current liabilities, and our non-current liabilities amounted to 66,000 rands. So now we just add those two, or that one amount, which is 66,000 rands. Then now we have to totalize our trade and other payables. Give total of trade and other payables. Trade and other payables is 126,540 plus 1,500 plus 300 plus 2,000 plus 3,600, and that will give us an amount of 133,940. 133,940. Then after we say plus 54,000 rands, which was the short-term portion of the loan. Short-term portion of the loan. 133,940 is here on top, not at the bottom. Then we add the two to get the total of the current liabilities. Get the total of the current liabilities, and I think that will give us 187,940. Let me confirm that. 54,000 rands plus 133,940, it is 187,940, plus 66,000 rands. That will give us the total of liabilities as 253,940. Then we add our equity and liability. We will say plus 2,685,977,000. That gives us 2,939,917. So now we have to compare the two and check if do we get the same amount as our assets. Yes, our assets is 2,939,917, and our total equity and liability is 2,939,917. So now that means our financial statements, they do balance, and that is very important to take note of. So now I will be doing the few ledger accounts that were required, one or two of them, so that at least we are also familiar on how to do ledger accounts. The ledger account that we were required to do is the ledger account of telephone, salaries, and stationery expense, then after advertising expense. I would like to touch base mainly on this so that I will touch base on other expenses later on. So now I will do only the stationery expense, then after I will do others in the next video. Then now let us just do the stationery expense, not to say others are not important. Stationery expense account, stationery expense or stationery used, stationery expense or stationery used. Then we draw a line as usual, and we know that we first have to take the total from the trial balance, and the total of the stationery from the trial balance was 14,000 rands, not the opening balance, the stationery as an expense. And our stationery expense in the trial balance, there we had our stationery expense as 14,000 rands. Then now in our adjustments, let us go straight to the adjustments, because adjustments will tell us what was recorded regarding the stationery. Regarding our stationery, we had a reversal entry where the stationery was reversed, and this was the reversal entry of the stationery. There the stationery. And our stationery expense was debited. Here the stationery expense on the debit side, stationery expense, here it is. So now that means our stationery expense was increased by 700 rands, and the contra entry will be stationery on hand, because we're cancelling the stationery that was on hand last year. Then we debit our stationery on hand, or debit our stationery expense by stationery on hand, and the amount will be 700 rands. So now that will be the amount to be recorded, stationery on hand, 700 rands. Then we check for another journal entry where the stationery was accounted for. So far there is no stationery. The next one, there we have stationery, yes, under number 8, where the owner took stationery for personal use, and stationery expense was credited because we were reducing the stationery expense. So now meaning in this case we have to record this on the credit side because stationery expense is credited. Therefore now the contra entry will be drawings, which is the reason why the stationery is decreased, because the owner took the stationery for personal use, and that is called drawings. Then after under entry number 9, we also had stationery there, where the stationery expense was credited by 4,270 rands. So now we also have to credit our stationery expense because it is credited by 4,270 rands. And the contra entry will be stationery on hand. Contra entry will be stationery on hand. So now after we have recorded all that, we can calculate the total of the bigger side, and the debit side will always be bigger. Credit side will never be bigger than the debit side in this ledger account, never. So now we have to calculate the total of the bigger side. Then when we do that, we will say 14,000 rands plus 700, that will be 14,700 rands. 14,700 and 14,700. Then we have to subtract the credit side, and the credit side is less 750 and less 4,270, and that will give us 9,680 rands. That will be recorded to profit and loss account. So now if you see that the amount of the profit and loss that we have recorded as 9,680 is the same amount that appears in the income statement, 9,680. It must always be like that when it comes to expenses. So now if you see, just as a confirmation, our stationery expense, there we have stationery expense 9,680. So now with that being said, I can say guys, all the best on my side, and thank you. Hope you have learned something out of this exercise. God bless you.